On January 27th, 2025, the richest company in AI lost $589 billion in a single day. That's more than the entire GDP of Sweden, gone in 24 hours. The stock market panicked. Investors were furious, and CNBC anchors were calling it the end of the AI boom. But 90 days later, Nvidia was back within 5% of its all-time high. So what caused the biggest single-day wipeout in U.S. history? And how did Nvidia recover so fast? The answer reveals how the AI war is really being fought and why the rules of Silicon Valley just changed forever. You're watching Tech Breakdown. Today we're diving into the story of Nvidia's $589 billion crash and comeback. This isn't just about a stock dropping. It's about fear, power, and how one Chinese startup called DeepSeek shook the entire tech industry to its core. To understand why investors panicked, you need to know why Nvidia became worth $3 trillion in the first place. For 2 years, Nvidia was the undisputed king of artificial intelligence. Every major AI company, from OpenAI to Google to Meta, needed one thing to build their models: Nvidia's H100 and Blackwell chips. These chips weren't just hardware. They were the picks and shovels of the gold rush. And Nvidia was selling them as fast as they could make them, with profit margins over 70%. Wall Street loved it. The stock went up 800% in 2 years. Nvidia became the most valuable company on Earth, briefly beating Apple and Microsoft. But on January 27th, 2025, that story got interrupted by a single blog post from a company almost nobody had heard of. The company was DeepSeek, a little-known AI lab from Hangzhou, China. They released a new AI model called DeepSeek R1. On paper, it matched OpenAI's GPT-4 and Claude in reasoning, math, and coding. But here's the part that broke the market. DeepSeek claimed they trained it for only $6 million. Compare that to OpenAI, which spent over $100 million training GPT-4. And they did it using Nvidia's less powerful H800 chips, because U.S. export controls blocked them from getting the best ones. Investors immediately asked the obvious question: if a Chinese startup can build a world-class AI model for $6 million using older chips, why are Microsoft, Google, and Meta spending $50 to $100 billion on Nvidia's most expensive GPUs? The fear was simple. What if the entire AI infrastructure boom was overhyped? What if companies didn't need to buy millions of Nvidia chips anymore? What if the demand curve was about to collapse? What if the $2 trillion AI build-out was based on a lie? The market reacted instantly. Nvidia opened down 12% and closed down 17%. In one day, $589 billion of market value disappeared. That broke the previous record set by Nvidia itself in September 2024, when it lost $279 billion in a day. For context, that's bigger than the market cap of Netflix, Starbucks, and McDonald's combined. Analysts were calling it the Sputnik moment for AI. Hedge funds started selling tech across the board. Even companies like AMD, Microsoft, and Broadcom got dragged down. The Nasdaq had its worst day in 8 months. But the panic missed 3 critical details. And those details are why Nvidia recovered faster than anyone expected. The first detail is about what DeepSeek actually used to build its model. And it changes everything you thought you knew about the crash. Here's what the headlines didn't tell you. DeepSeek R1 was trained on 2,048 of Nvidia's H800 chips. Those chips are a downgraded version of the H100, specifically made to comply with U.S. export controls. So even the company that caused Nvidia's crash was still 100% dependent on Nvidia hardware. Second, the $6 million figure was misleading. That number only covered the final training run. It didn't include the cost of research, experimentation, data collection, and the thousands of earlier training runs that failed. Real estimates from SemiAnalysis and Bernstein put DeepSeek's total investment closer to $500 million. Still cheap compared to OpenAI, but not magic. Third, and most important, DeepSeek's efficiency actually increased demand for Nvidia chips in the long run. This is called Jevons paradox. When something becomes cheaper and more efficient, people use more of it, not less. Think about it like this. When LED bulbs became 90% cheaper, people didn't use less electricity. They bought more lights, left them on longer, and used them in places they never had before. The total electricity used went up. The same thing is happening with AI. If you can run a powerful AI model for 10% of the cost, suddenly millions of startups, researchers, and companies that couldn't afford AI before can now afford it. That means more AI applications, more inference requests, and more chips needed to run them. Jensen Huang, Nvidia CEO, explained it in one line during the earnings call. Inference time scaling requires exponentially more compute, not less. In simple terms, as AI gets smarter and cheaper, it needs more chips to run, not fewer. And the big tech companies agreed. In the earnings calls after the crash, Microsoft said they were still spending $80 billion on AI infrastructure in 2025. Meta confirmed $60 to $65 billion. Google said $75 billion. Amazon said $100 billion. None of them were slowing down. So the market realized they had overreacted. The AI build-out wasn't canceled. It was just getting more efficient, and efficiency creates more demand. Nvidia's recovery started 48 hours after the crash. The stock stopped falling when analysts ran the numbers and realized demand wasn't going away. Then came the earnings report for Q4 2024. Nvidia reported $39.3 billion in revenue, up 78% year-over-year. Data center revenue, which is mostly AI chips, hit $35.6 billion. The company also gave strong guidance for the next quarter, saying Blackwell chip production was ramping faster than expected. That was enough. Investors remembered that Nvidia wasn't a hype company. It was making real money, real fast. The stock climbed 8% the next day, and the recovery was on. By March 2025, Nvidia had regained over $400 billion of the lost value. By June, it was back above $3 trillion in market cap. The reason is simple. There is still no real competitor for AI training at scale. AMD's MI300 chips are good, but they're 12 to 18 months behind on software. Intel's Gaudi chips barely have market share. And China's SMIC can't produce advanced chips due to US sanctions. Nvidia controls roughly 92% of the AI accelerator market. When you have a monopoly on the most important resource in the fastest-growing industry in history, short-term panic doesn't kill you. It creates a buying opportunity. But the crash did leave one lasting impact. And it changes how investors think about AI risk forever. The $589 billion crash taught Wall Street a brutal lesson. In AI, efficiency and disruption can come from anywhere. A 200-person lab in China with export-restricted chips can challenge OpenAI and Google. That means the barrier to entry is falling, and competition is coming faster than anyone expected. But it also proved Nvidia's moat is deeper than most thought. It's not just about making fast chips. It's about CUDA, the software platform that every AI researcher uses. It's about the ecosystem, the partnerships, and the fact that retraining AI models on new hardware is expensive, slow, and risky. Switching from Nvidia to AMD isn't like switching phone brands. It means rewriting thousands of lines of code, retraining models for months, and accepting lower performance. For a company spending billions, that risk isn't worth it. So what's next? The AI arms race is shifting from training to inference. As models get cheaper, the demand moves from building them to running them. And inference happens on Nvidia chips too. Every ChatGPT query, every AI image, every AI agent running in the background, it all runs on GPUs. That's why analysts at Goldman Sachs and Morgan Stanley still expect Nvidia to grow 30 to 40% per year for the next 3 years. The market that crashed in January came back because the underlying business never broke. Revenue was still growing 78%. Margins were still 70%. Demand was still outpacing supply. The real story of Nvidia isn't about losing $589 billion. It's about how fast the world realized it couldn't build AI without them. And in tech, That kind of indispensability is worth trillions. If you want the full breakdown of Nvidia's Blackwell chips and why they're 30x faster than before, let me know in the comments. And subscribe for more deep dives into the companies shaping the future.